Potentially, I think the question about the data is when is it going to start to matter? At the moment, what we see is backward-looking data that maybe is starting to capture the first impacts of the tariffs. But what matters much more is when we move through June, July, does the data stay very resilient? In which case, that's going to create question marks for the bears. I think the consensus is that the data will start to soften as we move through the summer. So I think at the moment, it's very hard to get a positive risk signal or an all clear from inline data.
Paul, this is really important to continuing claims breaking out yesterday. Veronica Clark mentioned that at the end of May, we don't have a clue. No. Except we said that at the end of December last year as well.
Here we go. So given that uncertainty, Greg, do you find your clients, are they coming to you and say, I want to have more protection around my portfolio than typically? Or are they just saying, I can't worry about this stuff?
I think people are more defensively positioned. We look at this through a quantitative lens where we aggregate a lot of the flows in the equity market, and we've produced this composite equity positioning indicator, and it scales from 0 to 100, so it's pretty easy to read. We were at euphoric levels at the end of last year, almost 97 out of 100.
Wow.
Things got very washed out post-Liberation Day, and now we've made our way back into this more neutral territory. That indicator sits in the mid-40s, so it points to a market where people are more defensively positioned, but we're not as bearish as we were from a positioning landscape a month ago.
97 reading? I kind of remember those days. It was like we have an administration that's going to be pro-growth, less regulatory, and boy, times have changed.
It was 6 months ago, but it feels like a lot longer than that.
It does. It does. What's kind of the smart trade somebody's come up to you with recently? Like when your clients have called you and say, hey, we'd like to do this. And you're like, really?
I think the things that people have been doing have been more nuanced. As we were discussing earlier, it is looking at ways to fund trade. So if you're looking at the optionality complex and like I do, you think maybe there's value in owning some of that September optionality where the data starts to matter a little bit more through the summer, it's looking at smart ways to try and finance that. So, one of the things that we were talking about in our tariff fatigue note yesterday was how to fund those hedges. So we think looking at things like covered calls and things like the energy space is probably an interesting way to look at that.
So what's a covered call in the energy space? Translate that.
So a covered call is simply if you are long the stock and you are selling optionality against that, such that you are not nakedly short that option. And in terms of the energy space, that could be one of the energy ETFs, such as XLE or XOP or some of the large energy stocks. It's a very benign strategy, but a way to eke out a little bit of yield that we think you can spend on hedges.